AICPA Town Hall, a high-impact news broadcast to help you navigate the most pressing issues facing the profession. Get timely and critical information, real-time interpretation, and analysis. Learn strategies, best practices, and capabilities to drive long-term success for your clients and organization. Thursdays at 3 p.m. Eastern Time.
Good afternoon and welcome to the AICPA Town Hall. I'm Eric Auskerson, one of your hosts for today, and it's August 4th, and we've got a very full hour in store for you. There is a lot going on. I know you've all heard about the news from Washington, D.C. about the $740 billion reconciliation bill, vastly expanded. We'll be unpacking that. We're also going to be doing some technical updates and giving you some best practices related to risk management. So thanks for joining us, and let's get into it. So here's the agenda. Once again, we'll kick things off talking about what's happening in Washington, D.C. It is not the doldrums of summer. A lot is going on. We'll then get into some technical updates, give you some best practices related to risk management, and then close with the open forum. So here's today's presenters, and who I want to bring up right now is Lauren Thingstag. You all know her. She's been on many town halls, very highly regarded, and she's been working very hard at getting the best information available related to what has happened. And as you heard at the last town hall, we thought it was just going to be a very restrained reconciliation bill. Well, that, Lauren, is not what has happened. It's been a long, winding road, and everybody is very surprised with this latest twist.
It almost feels like an understatement to call it a long and winding road. This is shocking, frankly. People really thought, for reasonable reasons, that this bill was going to be a very narrow healthcare bill. And now it's looking like this could go to the floor of the Senate as early as Saturday at noon. And it's not a narrow healthcare bill anymore. It has some significant tax provisions, and it's got a huge investment component in energy tax credits and investments that I think the profession is going to be really interested in.
Yeah, this is very, very significant. So we'll not certain it's going to pass, but if this does, Lauren, this is going to be a big impact for the firms and the way they advise their clients this fall.
Absolutely. And just to remind the audience, I know Barry did this last week, but I'm going to say it again. A reconciliation bill means that it's privileged. This means that the bill can move very quickly. It can avoid a filibuster in the Senate. And you only need 51 votes rather than the usual 60 to get this bill through the Senate. And the Senate obviously is split 50-50 right now. So all Democrats need is for their entire caucus to remain unified, for Vice President Harris to cast a deciding vote, and then they have their bill. And because of that 50-50 split in the Senate, Senators Manchin and Sinema, who are two of the most moderate Democratic senators, have been able to wield outsized influence on the scope of the bill. Up until this point, Senator Manchin has been the senator that everyone is focused on. He's been very public about his positions. He's been in the press a lot. Senator Sinema has been more of a behind-the-scenes negotiator. So when Manchin said, Eric, on July 15th, that he could not support a broader reconciliation bill, that this was going to be essentially a healthcare bill, everyone took him at his word and thought that a larger bill was dead. He did hedge a bit on, sorry, I didn't mean to cut you off, Eric.
No, so it is amazing. So what happened? How did we get here?
I think this is simply a matter of Senator Manchin changing his mind. He was subject to extreme lobbying. Bill Gates was calling him. He had economists calling him. And critically, he had a number of well-respected economists calling him and telling him that this bill would not increase or worsen inflation, which was one of his chief concerns. So I think he got comfortable very quickly. There was also a side deal cut on some permitting reforms that would directly benefit the state of West Virginia. That deal is not signed, sealed, delivered. It still has to happen. but there was enough content to make Senator Manchin happy with the bill that he was willing to move forward. And when I say that long and winding road or it being a surprise was an understatement, I can't stress that enough. I was on the phone with a Democratic senator talking about an unrelated issue when the news broke on, I think it was Wednesday night on July 27th, that there was going to be a larger reconciliation bill. And what that senator said on the call can't be repeated publicly on a town hall. This threw everyone by surprise. And if you think that Democrats were surprised, oh my goodness, Republicans were thrown for a loop. I don't know if people will recall from the last town hall or 2 town halls ago, but Republicans had been threatening to withhold votes on that Chinese competitiveness bill, the CHIPS Plus package, because they didn't want reconciliation to advance as a large, comprehensive bill. So to Republicans, it may appear as if Manchin said, okay, we're not going to do a reconciliation bill that's large. And then Republicans responded by saying, great, we'll put up the votes for the CHIPS bill. It passed. And then literally hours later, the large reconciliation deal was announced. And I need to talk about that frustration because it's going to have an impact on bipartisan bills later this year. So the retirement bill, I know we've talked about that on this town hall before. That could be in jeopardy. The tax extenders bill will probably still happen, but if Republicans are truly frustrated, they have opportunities to take out that frustration on bills later this calendar year.
Well, it was quite a poker game that Schumer and Manchin played. There's a lot of comments coming in. What did Manchin get out of this? But Lauren, one thing that I know you've been talking about that there was a lot of compromises here. So, I mean, this is quite different than Build Back Better. I mean, if we had right now, say we had Bernie Sanders on, he would comment and say that this is nowhere near enough.
Yeah, you're going to see Bernie Sanders offering up many amendments when this bill hits the Senate floor. You're right, Eric. This was originally, a $6 trillion package as envisioned by the Democratic administration. And the bill that passed the House was around 1.75 trillion, right? The bill that passed back in late 2021. We're talking at a bill that comes in at less than $1 trillion total. So it's a shell or a remnant of BBB, but this is still much bigger than the healthcare focused bill we were predicting 2 weeks ago.
Well, do you want to unpack a little bit of it for the town hall audience here?
I do. And so we're going to unpack the revenue components, or 3 of the most important revenue components in the bill. Before I start unpacking it, I do want to say this is still fluid. This is still fragile, right? The content could change at the last minute. Everyone is waiting to see what Senator Sinema, who's been the quieter of the 2 very moderate Democratic senators, says. And she so far hasn't said much. But the fact that it's fluid, it's fragile means that, I could go over these content provisions with you now, and then one of them may not be in the bill come Saturday or Sunday. But let's break down the revenue components. The most important one for the profession is obviously the inclusion of a new minimum tax on book income for large corporations. Some version of this has been in every iteration of a reconciliation bill. It is the largest revenue raiser in the package, and its basic goal is to ensure that if a large corporation reports profits on its financial statements but reports low or no income to the IRS, that it has to pay some amount of tax on that difference. Is there an easier way to raise corporate tax revenue? Yep, raising the corporate income tax rate would have been far easier. And the vast majority of Democrats, Eric, really wanted to see that in a bill. But this was one of Senator Sinema's red lines. She said early on she did not want to see that included in a bill. So Democrats pivoted to what they thought was the next best alternative, which was this corporate alternative minimum tax, the corporate AMT. And the way that it's currently structured, and I'm going to get a little weedy here, this tax is going to be imposed on any corporation with average applicable financial statement income in excess of $1 billion over any consecutive 3-year period preceding the tax year at issue. For a corporation that's not been around for 3 years, it's newer, the income test would be applied on an annualized basis. And the financial statement income is going to be determined, obviously, by reference to the income or loss in the company's audited financial statements. It would be subject to certain adjustments, things like, do you have income from control of foreign corporations, partnerships, certain taxes paid. And it wouldn't apply to certain entities. It's not going to be applied to S corporations, regulated investment companies. I think real estate investment trusts are not included. And there are some additional exclusions that are either in the bill or are being considered. Some of those exclusions, however, have to be determined or defined by Treasury regulations, which is going to leave, a lot left till the last minute. If this proposal, as enacted, passes, it applies to tax years beginning after December 31st, 2022. So if this proposal passes, calendar year-end companies, and right now we're talking the largest, right? Like the biggest companies, would have to start preparing as soon as possible for that January 1st, 2023 effective date.
Yeah, I mean, this is quite significant. I mean, this is something that's been talked about for 30 plus years, leveraging the financial statements for some tax policy. So I know the AICPA just sent a letter to Congress related to this.
We did. We've been at the forefront, frankly, of public advocacy efforts attempting to explain the myriad of problems that are going to accompany this. This is not good tax policy. I think even the proponents will admit, if you really press them, this is not necessarily good tax policy. The first problem that you can all, everyone's probably aware of, is taxing book income is going to reduce the value and the informational quality of financial statements. The large companies are going to have an incentive to overstate their expenses, understate revenues, and try to avoid the tax. One of the other things we are really concerned about is that when you outsource a piece of the tax code to the Financial Accounting Standards Board, you're kind of encouraging Congress to lobby FASB for or against changes to independent accounting standards. That's not good. And then leaving so many critical details up to guidance from Treasury and the IRS, you're going to leave corporate managers in the dark until that guidance is released. And I think the proponents of this would argue, well, it's only going to affect, 150 companies or so. They're going to be the best resource companies. They have time and money to lobby Treasury. And it really depends on who's in place. And I don't know that that's the way that we should be creating, smart, effective tax policy.
And today it's 1 billion, and tomorrow it could be something different.
That's such a good point, Eric, because in 2 years, when people are looking for more revenue, you could just take that threshold down a little bit lower and lower and lower to capture more and more companies. In our letter, and you referenced Eric, and I appreciate that we sent today to Congress, we're saying if the tax is enacted, which we hope it isn't, but at this point it feels pretty baked in, we're recommending that the effective date be delayed until after December 31st, 2023. We just think Treasury is going to need a lot more time to help corporations comply with this new tax.
We're getting some nice comments about the letter. It is in resources, and we'll also be highlighting that with the town hall newsletter, which will come out next week.
Great. I'm going to spend just a minute on the second revenue component that I think we'd all be interested in, because this is the expansion of the carried interest rule. It looks at this point like Senator Sinema may be successful in getting this stripped from a bill. There are various reports saying that she has told Majority Leader Schumer that she will not vote for a bill that includes this. It only raises $14 billion over 10 years. So losing this in the bill is not going to kill the entire package, right? It's going to mean there's a little less money for deficit reduction. If it does remain in, the change is that you'd be requiring a private equity fund to hold their assets for more than 3 years by changing the 3-year holding period to 5-year. And that's just trying to address the fact that most private equity funds hold their assets for, I think it's 5 to 7 years on average. The last piece is IRS funding.
Yeah.
There is $80 billion in additional mandatory appropriations to the IRS that can be used through 2031. And the bulk of that funding, about $47 billion, would go towards the IRS enforcement function. And I think it's just $3 billion that would go to taxpayer services. And at this point, I think we're all thinking the same thing. Why in the world are we throwing so much money at enforcement and so little money towards service when service is at an all-time low? And Congress is keenly aware of that fact. And the answer is revenue. The Washington scoring wizards took a look at this, and they think that giving the IRS multi-year mandatory funding stream, which will be helpful, but they think it's going to give the service the funding certainty it needs to rebuild its audit staff, make long-term commitments to technology upgrades. And that should bring in additional collections stemming directly from auditing high-income people at higher rates. We, as an organization, obviously have concerns about the imbalance between the enforcement and the service funding, and we urge Congress in our letter today to commit in a bipartisan manner to determining, the appropriate level of service for the IRS and to give the service the resources it needs to meet those goals, either in this package or in a separate vehicle.
Well, Lauren, just closing out this slide, I mean, that was a great review of the three top revenue items. This $433 billion in investments, that is something, as you said, we'll work on and provide greater information on an upcoming town hall. Clearly, a lot of climate credits there, over $300 billion. And then this projection there's lots of comments about deficit reduction, this projection of the deficit being reduced by over $300 billion over the next 10 years. But anything you just want to add at a high level related to those two?
High level is that I think it's the energy, the climate investment section that is the most significant. I think it's going to have significance to the profession, and you could spend an hour unpacking each and every single one of those provisions. So I'm hopeful that we have an opportunity to address that on a future town hall, because it is going to be important.
Well, do we want to move now and talk a little bit more about what's going to happen? And, there's questions here. Why do they have to rush right now? Why is there a big rush related to getting this all done? And this wonderful term that we're all learning more about, the Voterama.
Voterama. Yeah, no. So I think most of the reports would tell you that Senator Schumer and Speaker Pelosi are rushing to get this bill done because members want to return home for August recess. I'm here to tell you that's not the case. The Democrats are rushing to get this done because they only have a 3-vote margin in the House. There are 2 special elections coming up in mid-August that are predicted to fall into Republican hands. So they'd be electing Republican members of the House. Speaker Pelosi knows that she cannot afford to lose any votes in the House with her caucus on this bill. She does not want to take a vote in mid-August or mid-September where she only has 2 votes to play with. So they are trying to get this done before they lose, their margin narrows even more. And I think it's going to go to the floor in the Senate on Saturday at noon. And you're going to spend about 24 to 48 hours on the floor trying to get this done. And the Voterama, it is a procedural landmine. And for people who don't know what a Voterama is, I say it's like a 24-hour game of dodgeball. It's stressful. It's physically exhausting. It's not fun. And it after a certain amount of time has elapsed on debate on the bill, it means that any senator can offer an amendment, and senators keep offering amendments until until they all give up. So if Senator Rand Paul wants to offer 500 amendments to the bill, he can do so. And it's one of the procedural landmines that I think will not kill the bill, but it's going to draw it out in the Senate. The other one simply is you need 50 healthy Democratic senators on the floor who are able to vote for the bill. The House has proxy voting right now. You can vote remotely. That's not the case in the Senate. We've seen Democratic senators announce their COVID diagnoses in the last 2 weeks. Senator Manchin had COVID last week. So if today or tomorrow a Democratic senator announces they have COVID, they have to go into quarantine. You don't have 50 votes in the Democratic caucus to get the bill done, and that delays the bill, and that's really problematic. Now that I've kind of talked about the procedural landmines, there are still some policy landmines, right? People might be asking, what about SALT? SALT isn't in the bill. I thought there were 3 or 4 House members who said they wouldn't vote for a reconciliation bill unless it addressed SALT. And it looks like the House SALT caucus is collapsing quickly. There will be amendments filed to the bill in the Senate that attempt to address SALT. But I think most members, even those who care very, very deeply about SALT, are going to recognize that it's better to take this bill and fight the SALT cap another day.
Well, Lauren, I mean, this has been an unbelievable review. I worry that we'll lose you to a Sunday morning talk show, kind of, explaining what has happened and where things are going. So this is, this weekend, I guess, watching C-SPAN there'll be a lot of people in DC doing that. And it seems like doing this in August, it'll be stressful because people will want to get home. And as you noted, these health concerns. So, where do you think we'll be on August 25th here? What's
August 25th, I think this bill will have been signed into law, and maybe not in its current form. Again, there could be changes even up until the last minute, but I think by mid-August, we're going to have a reconciliation bill that is done and signed into law. The last thing I want to point out, Eric, is when Congress moves fast, they make mistakes, right?
Right.
They're not perfect. We saw this on the Tax Cuts and Jobs Act. There were mistakes that we and others had to help clean up. So this is going to move very quickly. It'll pass soon in both the Senate and the House, unless something happens that we are not expecting again. And there are probably going to be technical mistakes that we need to help give Treasury guidance on. And that's a process that usually lasts a year or two.
Well, thanks, Lauren. We'll have you back for open forum, and we will be talking about, some of the spend elements in an upcoming town hall, and also this corporate tax change is quite dramatic. So we'll clearly be talking more about that. But just great overview, and thanks for that. And we'll have you back shortly. So now we're going to pivot, and Carrie Hipsack is here this week. Lisa Simpson is out. She'll definitely be back on the next town hall. So she sends greetings. And Carrie, I know there's a number of things going on with the SBA as well as some things with the IRS that you're going to cover for us now.
Definitely. Thank you, Eric. The legislative activity is a tough act to follow since it's so exciting, but hopefully this is some good news to share with our attendees as well. Let's kick off with a Shuttered Venue Operators Grant, or SVOG, update. The SBA hosted a webinar on July 14th regarding audit requirements for SVOG for-profit entity recipients. The first item to address from that webinar relates to the audit submission deadline. Before getting into the details of an available extension, I'd like to draw attention to the bottom left-hand portion of this slide about this extension only applying to for-profit entities and excluding non-federal entities, something to take note of there. The typical deadline for SVOG recipients subject to a single audit would be 9 months after the fiscal year end. For example, a for-profit entity that had a 12/31 year end would have a September 30th audit submission deadline. Many SVOG recipients and their auditors have voiced concern about this deadline without SVOG for-profit guidance available from the SBA yet. In response, the SBA did announce a 9-month audit submission extension. This extension will be the latter of 9 months from the date of the SBA's guidance or after the end of the fiscal year. Since this extension may be impacted by when guidance is released, when is guidance expected? On the next slide, I have it noted that guidance is expected shortly. While I don't have an exact date to share, the SBA did share some of the options that will be made available to meet the SVOG audit requirements. The first is a typical single audit in accordance with the uniform guidance, or a program-specific audit conducted in accordance with the uniform guidance. Before I address the last two options, I'd like to share a refresher of what the uniform guidance is. In its simplest form, the uniform guidance is the set of authoritative rules regarding federal grants from the Office of Management and Budget, or OMB, that helps to ensure federal funds are used in accordance with their purpose. For those who may not have as much experience with single audits or the uniform guidance, the last two options may sound a bit more familiar. Those options are an audit of the financial statements or a compliance examination attestation engagement. While we wait for more detailed guidance, I'd like to share a final reminder of what triggers an audit for SVOG recipients. Typically, a single audit is triggered when an entity expends $750,000 or more of federal funds in their fiscal year. When it comes to for-profit SVOG recipients, the audit trigger is $750,000 or more of SVOG revenue, not expenditures, but revenue recognized in the entity's fiscal year. Let's move on to a very brief update about another economic recovery program, the Coronavirus State and Local Fiscal Recovery Fund Program, or the maybe easier acronym of CSLFRF Program. Similar to the SVOG for-profit recipients, many CSLFRF recipients are entities that may have not previously been subjected to single audits. An alternative was provided in April for a compliance examination report that would be less intensive than a single audit, but would still provide a check that the federal funds were used as intended. In more recent news, the AICPA's Government Audit Quality Center, or GAQC, which you may have heard of on past town halls, has provided illustrative reports to assist practitioners that are performing those engagements for CSLFRF recipients. Next, we have a topic that was very hot in the town hall Q&A a few weeks ago, CP14 or balance due notices. The IRS has issued a statement regarding the misapplication of payments for 2021 joint tax returns, which was triggering those CP14 notices. This primarily occurred when the second taxpayer listed on a married filing jointly return submitted a payment with their online account. In their notice, the IRS indicated what taxpayers should do at this point. If it is known that the amount was paid in full and on time, there is nothing that needs to be done. If it is known that additional tax is due, taxpayers can pay the remaining balance in full, enter an installment agreement, or request additional collection alternatives. If there are questions about if the amount has been paid in full, payment on the account can be confirmed by checking the online account under the Social Security number, or SSN, that made the payment. One more IRS-related update is the release of the draft 2022 Form 1040. There have been questions in the past about what is included in the virtual currency question that has been included on the 1040. In 2020 and 2021, the question was relatively stagnant, with the primary update related to the year and one minor word change from acquire to dispose of virtual currency. In 2022, the IRS has added a bit more detail to this item on the 1040 and is now asking for reporting on digital assets. This can be considered a definition expansion due to cryptocurrency being only one form of a digital asset, but now there are other digital assets that could have tax implications. Before we move on to the next slide, I do want to quickly draw attention to a topic that we don't have a slide on, unfortunately. The Restaurant Revitalization Fund, or RRF, has approximately $180 million of unspent money that is allocated to the program. And this came to light in a Government Accountability Office report on July 14th. In response, the National Restaurant Association, or NRA, called for the distribution of that money in a letter on July 27th. Going forward, the SBA will work with the Department of Justice to disperse those funds. So that is good news for some of those restaurants that were hoping to be a part of that program and were unable to get those funds. Those will now be allocated. And one final ask I have is for all CAS firms that have not yet already completed the 2022 CAS benchmark survey. This survey is open until tomorrow. Your insights are vital to our understanding of the impact of the past 2 years on CAS, and your firm can use the data to benchmark with your peers. We hope you'll take the time to participate before the survey closes tomorrow. And with that, Eric, I will turn it back to you for a very fantastic conversation.
Well, hey, thank you, Carrie. And you covered, this is where we pay attention to the questions on the town hall. You addressed a lot of them with that update on many different subjects. And I'll tell you right now, this week we got over 7,000 attendees, and the questions are coming in at a very, very fast pace. So thanks, Carrie, and we'll have you back for open forum. So now I want to invite Stan Sterna from Aon and Sarah Ferenc from CNA, two individuals who I think many of you know. The AICPA has a long-standing 70-year plus partnership with Aon. We've got 18 different, professional and personal insurance plans that are supported by committee management. And both Stan and Sarah really are experts in managing risk in your practice. And over the past year plus, we've received a lot of questions related to risk management, some related to, professional liability plans. So what we've decided is we're going to have on a quarterly basis, potentially, a discussion around managing risk in your practice. So first, welcome Stan, welcome Sarah.
Thanks, Eric.
Thank you, Eric.
So we're going to kick things off with a broad overview on how Aon and CNA see the key risk areas and some of the best practices related to them. So Sarah, I know this is something that you talk to new firms about a lot, as well as firms that have been in business for quite a while. So I'll let you clear at a high level some of these topics. And then what we're going to do today is we're going to do a deeper dive in a favorite subject of everybody's, engagement letters.
So thanks, Eric. Yeah, I mean, if it's a new firm that's just starting out, or if it's a firm that's maybe just joined our program and we're onboarding them, if someone asks me, okay, what are the basic things I need to focus on? Before I even start delivering services to my clients, what are my fundamental risk management practices? And I would say these are the top 5. And these are things that firms of any size, any area of practice, any location can implement, or regardless of how long they've even been in business. That we could probably spend at least an hour on each of them. We could probably spend 2 hours on engagement letters or more. And maybe those are topics for future town halls. But regardless of what kind of firm you are, client and engagement acceptance, engagement letters, communication with your clients, documentation, and then billing and collections are really 5 key sound risk management practices that all sizes of firms can implement.
Stan, is there anything you'd like to add?
No, the only thing I'd like to just note, Eric, is documentation. Whenever you're defending a professional liability claim, is really the cornerstone of a defense. And so out of all of these are important, but in terms of when you're actually on the ground defending a claim, these are document intensive cases, and it's critical in defending any kind of accountant's claim.
Well, let's talk a little bit more about engagement letters. It's always nice to kind of look at some data, and this is actually very interesting data. This is engagement letter use on claims, and this is some proprietary information from CNA.
Right. So let me explain a little bit more about what this graph is. So, when a claim gets asserted against a CPA firm in our program, one of the first things that our defense counsel, that our claim professional will look for is the engagement letter, because that is just the document that, that determines, that guides, what the firm was engaged to do. And so we track whether or not there was an engagement letter really when a claim was made. And as you can see, got some room for improvement in a couple key areas. And while you've seen engagement letter use on tax engagements decline over the last few years, and we can point to a few different reasons for that, whether it's dealing with new legislation and PPP and staff turnover and so forth in the last couple years. Historically, engagement letter use on tax services and consulting services has historically been pretty low, maybe hovering around 50% or so. And we know that when an engagement letter is there, it just gives our defense, a great tool to work with. And without one, we're starting back a bit in order to resolve that claim, hopefully in the CPA's favor. So, we track this information and despite our best efforts, and we still see decline in engagement letter use. So happy to be speaking about this with all of y'all today.
Well, we're going to move into talking about, we've got top five hurdles here and top 5 tips on ways to get over those hurdles. And it's a live show. We got a lot of questions coming in about sample engagement letters. Some people are finding them, some people, so that's absolutely something that Aon and PCPS works hard at. So why don't we get into first off some of these hurdles, Dan? People, I'm sure firms tell you all the time why they can't get around to doing them.
Yeah, we hear it a lot, Eric. And first I'd like to just note that a significant number of claims that we see in the AICPA insurance program involve engagement scope issues. So obviously engagement letters are a critical part of the defense, as I noted. So let's talk about some of the common obstacles or hurdles that we hear from practitioners. The first one is the most obvious. I just don't have enough time. I have urgent client needs. We were in the height of a pandemic. We had to deal with PPP issues, providing loan assistance and then loan forgiveness. We had tax deadline changes in the tax law. There's IRS service issues that was noted. There was also staffing challenges. So that's probably one of the primary reasons we hear. Another significant, and I'll take both of the next bullet points at the same time. We hear a lot, well, this is a long-time client. He or she will never sue me. Or, I've worked with this engagement with this particular client for years. And how do I introduce an engagement letter right now? And, our experience is long-term clients that you consider acquaintances and maybe even friends, do sue their CPAs. And, that's why they're called clients and not friends, so to speak. So you are in danger regardless of the relationship of a potential claim. Another thing that we hear is that the draft engagement letter is going to take much longer to draft than the actual services. And this usually happens in ad hoc or off-the-cuff type of advice. Or consulting projects that seem to have limited impact or are small projects but have significant impact on the business or are going to morph into much larger consulting projects. And then last is, services aren't just, these services aren't standardized. They're fluid in nature. And we've seen a significant rise in client accounting services and consulting engagements over the last few years. And it's admittedly difficult to define a wide variety, a wide array of client accounting services in terms of the scope in the engagement letter. Same thing with consulting. Consulting seems to, possibly morph into other types of projects. You might finish one consulting project and then it evolves into the next phase. So these are kind of the standard, I would say, top 5 obstacles that we hear from practitioners is why it's difficult to get engagement letters from their clients. Now, in terms of how to overcome those hurdles, what we recommend is level set expectations with the client in the beginning. And then subsequently thereafter, annually, when you're reviewing engagement letters with them. And I think one of the best analogies that I have is, maybe to appeal to the client's common sense. A client would not, or anybody would not retain a person to come in, a contractor, to do significant remodeling work in their house without having a written agreement, knowing the types of work that's going to be done, the deliverables, and how much it's going to cost. So why would somebody engage a CPA to provide financial advice without a similar written agreement? It seems to make it's just common sense. So appeal to the client a sense of, it's just good practice. Another thing that we will discuss is, or that we discuss with clients, is to make sure that you explain the benefits of the engagement letter to them. It's a mutual benefit. It's not one-sided. It provides the client with the opportunity to know exactly what the scope of the engagement is, the limitations of the engagement, the responsibilities of the parties, the deliverables, the fee structure, etc. And it also affords a particularly valuable opportunity to be able to further enhance a client relationship, and also further enhance your business strategy. And I know Sarah, as a former practitioner, could probably talk to how she used engagement letters, not so much as a compliance item, I need to get it done because it has to be done, but as a way to, like I said, to further enhance the client experience and to further advance business goals and business strategy of the firm. And Sarah, if you want to comment on that briefly.
Sure. I was in an audit for a number of years, and then also in consulting. And I think especially on the consulting advisory side, those kinds of engagements can be pretty much anything. It's just advice and recommendations. And so it's, taking the opportunity to have those conversations at the beginning of the service, at the beginning of that client relationship, really to understand kind of what their needs are, what they, how could you help, and kind of develop your scope from there. Now, I know that sometimes even just that process of understanding what a client needs, that can be a time-consuming thing too. And so a lot of times we would do almost like a phase 0 engagement, where it was more of almost like a needs assessment, where maybe you spent 20 to 30 to 40 hours meeting with the client, doing some high-level meetings, maybe high-level walkthroughs, and presenting the client your deliverable as here's what we could do for you, client. And then using that to not only draft the engagement letter, use that whatever is agreed to after phase 0 to draft the engagement letter, but it also is a way to demonstrate your value and get additional services. So using those engagement letters as tools to kind of take it to the next step. We've also talked to firms about, and I think this is also a good idea, scope expansion and scope creep. While generally, getting more services and expanding the scope is generally a good thing from a financial and business and service perspective, but from a professional liability risk perspective, we need to do it just a little bit carefully. And so maybe it's, if a client asks you to do something additional, and it's still within the general confines of the agreement, maybe it's just a quick, change order, or it could be even an email exchange, between the client and the firm, that you put in with your engagement work papers. So there's ways to manage scope and put an engagement letter or documentation, some sort of documentation in place related to consulting services that are not that are hopefully a bit more efficient and maybe less daunting than you might think. From an audit,
Sarah, just on that, just the question. There's a question that came in related to that. So this was just regarding tax services. They've got a large client, and then they get a new tax question. And they said it might take 1 to 3 hours of work to do that. Wasn't necessarily covered in the engagement letter. So the strategy you just outlined, the best practice may be just to do that email exchange for that extension, this tax question extension of service.
Yep. And I think it somewhat depends on what the question is and how general or specific it is, because 1 to 3 hours, it may be something, it might be only based on a limited set of facts that the client has told you. There might be additional information. So part of that email might be to, here's the information that I'm basing my advice on. Here's what I think based on this limited amount of information you've given me. If there's additional information, please let me know, or maybe please let me know so I can reconsider my advice. And oh, by the way, the terms and conditions of our other engagement letter that we have in place apply to this service as well. So I think you can do some good, an email, yes, but probably not a quick email. Probably need a little bit more oomph to it.
And then not everything needs to be signed. Because another person asked if they stated they sent, this is what the service will be, and they don't always get it back signed, but they say we're taking this as confirmation. What needs to be signed versus not signed?
That's what we would refer to as a unilateral engagement letter. I'm guessing is what they're saying. And those I think are great for low risk clients where you send out, say, the engagement letter with your organizer. It has all your terms and conditions in it. It includes a statement at the end, something to the effect, in a more eloquent way. Hey client, by returning your stuff to us and allowing us to prepare your engagement letter or your tax return, you're agreeing to the terms and conditions in this engagement letter. I think those are fine for you for lower risk clients, especially like those basic 1040 clients where you're churning them out, and chasing down thousands of signatures on a 1040 engagement letter just might not be practical.
Yeah. And one thing, if you notice on the bullet points, Eric, is we talk about considering use of ESignature. There is a federal statute, ESign Act. There is the Uniform Electronic Transaction Act, which I believe 49 states have adopted in one shape or the other. I think New York is the outlier, but they have their own e-signature statute. So if that makes it easier to obtain a signature from a client, utilize it. There are laws that validate these e-signatures. So that's an important consideration to make as well. Another thing that we say is, and we see this a lot, don't go from zero compliance to 100% compliance in like a massively short period of time. It's just impossible. So, and it's going to be confusing and it's going to be daunting, and you got other work to do, and we understand that. But one way you could tackle that is to take the high risk engagements, the high risk clients, and make sure that you have engagement letters on those, and then build it out from there with other clients. We usually find that's an effective way to go about actually reaching that 100% level in a relatively short period of time. It might take a year or two, but you'll get there. And then last but not least is blame your insurance company. We say that sort of in jest, but not really. I mean, insurance companies, especially insurance underwriters, when they're evaluating a firm for risk to provide professional liability insurance, is looking at things like, what is your engagement letter policies? Are you getting engagement letters? Are they signed? So, it impacts your the underwriting of your policy, potentially premiums, things of that nature. So that's one thing. Also, there are many policies out there that provide incentives and other benefits to encourage engagement letter use. So, I often will tell clients on the phone, blame me, blame Sarah, and we'll be the bad guys. And, it works because it gives somebody at least the opportunity to say, I understand it could be onerous. I understand it can be time consuming, but it's best practice and it's required by my professional liability carrier.
Yeah, we are totally fine being the scapegoat.
Well, on that, let's move to some resources. There's been lots of questions about, sample engagement letters. Actually, what's the state of sample engagement letters for the client accounting service or client advisory service area, the CAS area? So why don't you cover that and cover some of the things highlighted on this slide?
Sure. So, CNA provides sample engagement letters to our policyholders. I know other carriers do as well. So, there's a link there for our policyholders to log on to the Policyholder Resource Center to get those. Tax section members, we also provide our tax engagement letters to tax section members in the annual tax compliance toolkit. Other samples, when it comes to client accounting services, that's, there we do have a sample. That's one of those ones where it could be a lot of different things. And so working with the client to understand really what is the scope and articulating that scope in an appendix or something. I'm a big fan of tables. I think they just lay out things really nicely. So our sample includes a table as an appendix in terms of what specifically would be in scope for a CAS engagement. And then in terms of other kind of engagement letter questions, resources, there's our FRQ document right there. I know in the resources section or the materials section of the town hall platform today, there's another document that has some additional resources and articles to consider as well.
And the only thing I'd like to add, Eric, is, those templates provide folks with, a framework for building an engagement letter, which will make it, easier for them with regard to a specific service offering. There are also terms and conditions addendums that we have as a sample that can be used for, every type of engagement, just standard type of provisions. Some of those provisions help limit your liability. So not only does the engagement letter, define the scope and responsibilities and the limitations of the engagement and the fee structure, but also can help you limit some of your exposure, whether that's through, damage or liability caps or venue selection and things of that nature.
Thank you. I was going to mention that. So thanks, Dan. I appreciate you mentioning the terms and conditions document.
Well, one thing is we've probably got about 70 questions and feedback items on engagement letters during this session. So we'll leverage that. One thing I'd like to say is, last town hall, we had Ron Baker talking about concierge service. And, this week we're talking about engagement letters. And there are things in the engagement letter where you can describe, the services, the value that you're providing as well. So it's not just scoping it out from a professional liability standpoint, but leveraging the engagement letter as something to really highlight the value that your firm is providing. I'm sure if Ron Baker was on this call with us right now, he would be emphasizing points like that. So this is great. Just a great discussion today. Good thinking. Any final comments, Stan or Sarah, before we move into open forum?
I'd say there's a lot of resources out there to assist with engagement letters, whether it be sample, whether it be your carrier to consult with, whether it be articles. There's a lot of knowledge, there's a lot of resources. So definitely you're not alone in this, and leverage those resources to help you out.
Yeah, the only thing I would add is, as I noted, Eric, documentation is a key. Nobody wants to end up in a professional liability claim. But when we're defending a claim, one of the first things that we ask for is the engagement letter. We want to see the engagement letter. We want to see the work papers. We want to see the billings, and then any contemporaneous letters or emails or texts. So the engagement letter is the first process in a very critical stage of managing your risk and managing any claim that may be pursued against you. So
we look forward. Thank you. Thanks, Stan. Thanks, Sarah. Thanks for what you're doing for the firms. And we look forward to having you on a future town hall to talk about some of these other elements of good practice management, risk related to risk, such as client acceptance, billing practices. So more to come on this. And let's now bring Carrie and Lauren back. So Lauren and Carrie, I know you've been looking at the questions coming in. So I may ask you maybe to pick one out. Lauren, is there a theme of questions besides the fact that, a lot of the listeners thought you covered it very well, what's going on in DC and the next steps?
I saw a great question come in about what this new IRS enforcement funding in the reconciliation bill means for the IRS budget. And I'll clarify, the IRS is funded through the annual appropriations process. I think in the last fiscal year, the IRS was given about $13 or $14 billion to play with. This $80 billion in multi-year mandatory funding is on top of that. That translates to about, I think it's $8.9 billion every year in extra funding for the IRS. Now, that extra funding obviously is going to the enforcement, mostly half of it going to enforcement, some going to services. But that means it's really significant. And I think long-term, it's gonna make a difference at the IRS.
Thanks. Carrie?
I did see some questions coming in about how to get a piece of that 180 million of the RRF that is still lingering. And at this time, we don't have an answer to that question. So we'll take what we have, which is that we know that those funds will be distributed, but we don't know the exact answer yet about how. So stay tuned, and we'll share that with you all as soon as we get the details.
Well, I'll let you, Carrie and Lauren, keep looking for other questions. I just saw one back for Stan and Sarah. Someone's saying combining, multiple service line services into one engagement letter, combining the CAS, tax, and consulting into a one engagement letter. Thoughts on that?
I can take that one, Stan. I think you can do it. I think if you think that you have a 5-page letter for each and you can put them together in, say, a 7-page letter, 6-page letter, that might be a little bit of a stretch. I think you need to clearly distinguish what standards apply to what service. Because the client, and then also the client responsibilities, because they're going to vary by service. And so maybe you have sections within the same engagement letter to differentiate the services, and then the terms and conditions attached as an addendum that apply to everything. That would probably be the approach that I would take to put those in one, so the client then only has to sign one engagement letter. And I understand from a client perspective that no one wants to sign more than one document.
Thanks. So, Lauren, Carrie, other things you want to add to?
I think I scared some people when I said that the fight over reconciliation was going to jeopardize other bills this year. We've been talking about the retirement bill. We've been talking about tax extenders. I want to clarify, tax extenders is probably still going to happen. Still going to happen in the lame duck. Obviously, we have the research and development tax issue that's still hanging out there that needs to be resolved. That's going to be the glue that holds a tax extenders package together. Retirement bill, however, I'm sorry to say, is more up in the air. And so that's just a wait and see situation.
Eric, I'm sorry.
I was just saying, what's happened here in DC is quite amazing. We've seen a lot of big bills over the last couple of years. But another, $740 billion bill. It's actually 740 pages too, right, Lauren? It's kind of,
I think it is, yeah.
The irony, same number of pages. It's $1 billion a page, and just some big consequences related to tax changes for corporations. Also, the energy and climate items. We talked about ESG in the last, a couple town halls ago. And I know that, what we're trying to do here is just, provide support for the firms if they're needed to provide information, consulting or assurance or a test related to some of these climate policies. So these are just things that we are going to continue to study and bring you better information and better resources so you can, determine what you want to do. You don't have to go into every one of these areas, but determine what you want to do with your practice related to supporting your clients. So sorry, Carrie.
No, my apologies. There is one question I want to quickly get in, and that was related to that 2022 Form 1040 draft. What exactly is digital assets? And it is very broad. So digital assets obviously includes cryptocurrency, which sort of encompass that virtual currency that was previously included on that 1040. But digital assets also includes those non-fungible tokens, which has been talked about on a previous town hall. And then also things like virtual real estate and the metaverse. So it's very encompassing and is much broader than just that virtual currency that was previously included on the 1040.
So we'll be talking more about that, NFTs, non-fungible tokens. So there's an acronym for everybody. Well, thank you, Carrie, Lauren, Stan, and Sarah. Great having you on this Power Hour. So look forward to having you back on the town hall again sometime soon. So in summary here, lot covered. We share this with you just as a reference. Really some really great updates today. Here are the past town halls. Please leverage them. Coming up on August 25th, Barry Melanson, the CEO of the AICPA, will be joining us. Carl Peterson leads the small firm area of the AICPA. Lisa Simpson will be back on next week as well. We appreciate the discussion that continues on social media, leveraging this information, getting the word out. So thank you. Once again, we're taking an extra week break here in August, but we're going strong, and we will have 2 town halls in August. The next one's going to be August 25th And then we look forward to kicking off September after Labor Day with you on September 8th. So thanks for being with us today. We greatly appreciate your engagement and attendance. Have a good August, and we'll see you in a couple of weeks.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.